Kee, thanks very much for joining us. Tell me a little about the company and the strategy.
L1 Capital, we're an Australian-based fund manager with about $4 billion in assets under management. We're a global operation with offices in London, the US, as well as Australia. We were founded in 2007 by Mark Landau and Rafi Lam, and we're 100% owned by employees. We have a number of investment strategies across debt, equities, as well as property. All of them have had a very strong track record of performance since inception. In 2017, we started our investment strategy in UK residential property, and that's investing in blocks of apartments in the tier one cities outside of London. What we really liked about this strategy was we're able to invest in day one income generating assets, which historically provided a very stable and non-cyclical income, which supports an attractive dividend yield. And secondly, by investing in existing buildings, on average, we're buying at about a 30% discount to the replacement cost. And through refurbishments or repositionings, we're able to drive capital growth. The investment strategy for UK residential property has been fairly solid to date. So in our current funds, we've been delivering dividend yields of between 6 to 7% per annum, and a total return, when you include the capital growth on top of that, in excess of 10% per annum.
And you've decided to list on the stock exchange, Kee. What was behind that decision?
The objective is to look to raise up to £150 million on a premium listing on the London Stock Exchange. The residential property strategy, for us, it's very much around scale. It includes more customer data and improves our overall cost base. I think having been established in this market for 3 to 4 years now, we've seen a very large pipeline to support the growth in scale, and the listed markets provide us the flexibility to do that. Additionally, with the changes in the tax status for residential property from a direct investing perspective, the REIT gives a much more neutral tax status for this investment strategy. I think together with the listing, we are investing or providing a seed portfolio of about £150 million. So this supports the REIT where there will be day one income, as well as exposure to what we feel is a fairly attractive long-term sector with growth as more and more parts of the population in the UK choose to rent versus buy. So, for example, in the UK, in 2020, there were about 2 million renters. 20 years on, that number has more than doubled to about 5 million today.
And in terms of that outlook on the market, are you looking at specific regions? Where are you seeing the opportunities?
I think in terms of the specific locations, our focus is specifically outside of London, in cities such as Leeds, Newcastle, Birmingham, Sheffield, where rents are a lot more affordable, and we think that supports longer-term growth. What we like about the UK residential property market is that long-term, the underlying structural dynamics are very attractive. So there is a long-term imbalance between demand in terms of growing the number of renters versus supply. And when we also look at the underlying performance of UK rents and collection rates, it's inherently very non-cyclical and stable. So as an example, over the past 12 months, despite COVID, UK collection rates for residential has been really unimpacted at about 96%. So tenants continuing to pay, which is very supportive of the security of income. And when we look at rental prices over the long run, it's just really grown in line with people's wages at around 2 or 3% per annum. So we see the opportunity very much as outside of London, affordable markets, strong rental yields in a sector that's growing with more and more renters, demand and supply imbalance, and very stable pricing and collection rate.
You mentioned affordability. Why is that a key driver for you?
The number one factor for any renter in the UK is affordability. So when we look at an annual survey that Knight Frank does, the number one criteria voiced more than by 2/3 of the population is affordability. And at the end of the day, from our perspective, and we also have a social policy, is that we want to provide good quality accommodation at a price that people can afford relative to their incomes. When we look at where the listed markets participate in the housing market at present, there is a lot of demand from the institutions for very much the high end, which is the brand new build to rent schemes, which isn't affordable to everybody. And there's also a lot of support at the lower end, which is more the social housing side, by a lot of other listed peers. At present, there's limited institutional support or activity in the mid-market, which is the mass market, which we think is actually the most attractive part, being defensive. And ultimately, renting should be priced at a point that is sustainable for people's incomes so that they can spend their money on other things, and there's a strong social element to that. So we want to be in the affordable space where it's defensive. It's the number one criteria for tenants, and it's ultimately what the UK needs, fundamentally more affordable accommodation at a price that can be supported by people's incomes.
The affordability side has certainly been a growing topic in the market. Thanks very much for joining us, Kee.
Thank you.